Hello, everybody. This is PC here from Global Alpha Search. My monthly update coming your way. As usual, as we finished March with a great return of over 7%. So we kind of crushed it this month. Let's just get going and move on to the details, and I will explain you everything step by step. I will just present my screen. So 7.1%, that's the return for this month. And getting to the details, that's the portfolio overview. Our synthetic internal benchmark, which we have created some time ago, was up 64 basis points this month, whilst we made a return of 7.1%. Just for comparison, S&P 500 was up 3.8%, and the Nasdaq 5.7%. So looking here, you can see here on the right-hand side section, you can see the active return for the month of March and where it came from. As you can see, we have beaten the synthetic internal benchmark by 6.5 percentage points, and we have beaten the S&P 500 by 3.3 percentage points. So great return indeed. It came mostly from good timing and good positioning at the start of March. I will go into more details in just a sec on that. Major reasons for the outperformance were equity exposure hedges were netted out. All the time through January and February, we have been mostly hedged on our equity longs, and that's why we managed to finish both months in the green. And now we've added another green month because at the burst of the Russian-Ukrainian conflict, I have decided to basically net out all the hedges and go long, buy into some of the sold out stocks, as I have followed many indicators of the market, technical and fundamental, and I thought this is the best time to kind of buy into the facts, and it worked this month at least, right? Zeroed bond holdings duration. So our tilt holdings are all netted out right now by an opposite position in tilt futures, CFDs. So effectively our duration is now 0, but obviously fundamentally we're keeping part of our portfolio in the long-term treasuries. Directional equity longs with, via SPXL and eTRQQ also added to the active alpha quite nicely, as I have basically bought into the dips at the break of February and March, and then at the start of March, I have added a little bit as well. So the expectations of a rebound in March fully materialized, and we have obviously quite nicely profited on it. A current equity allocation is slightly below 50% in terms of pure equity allocation, but including the equity ETFs, we're closer to 60%. Cash as of yesterday, so as of the end of March, was slightly above 20%. In terms of exposure, equity longs are 48.5%. I'm not counting uranium miners here, and including the ETFs, we're slightly below 60% as well at the end of March. No indices short as of yesterday, but as I said quite a few times already this year, I do plan to stay agile in terms of hedging, because I think there's basically more and more volatility ahead of us this year. So I am basically keeping the window to be able to shorten equity indices to hedge our portfolio, at least on the equity side, dependent on the market situation. Treasury longs are almost netted out, so very tiny exposure, 1.6% here. Long gold, basically exposed to ETFs and commodities directly, comes up to slightly over 30%. Then the uranium miners, on an aggregate basis, our equity exposure at the end of March was almost 34%. That mostly comes from the fact that we're in the world of supply chain shocks, mainly coming from the commodity side, plus the inflationary pressures. It all adds up to a situation where I think commodities are poised to continue their run from here, and we'll talk about that later. I'll show you how it has developed on a month-to-month basis. Tiny strategic long-term holding in the crypto space only via Ethereum. It's not an asset that I trade ever. It's rather a tiny little option for additional upside in the long term coming from the general development of the crypto world via one of the most renowned cryptocurrencies, which is Ethereum. Our average risk score was 4, and the maximum was 6 at the break of the Russian-Ukrainian conflict. But on an aggregate basis, we're trying to keep it at around 4 to 5 during some increased market volatilities. As you can remember, possibly to January and February, we had much lower risk scores, mostly due to the fact that our portfolio was fully hedged. So we were at around 1, 2 to 3. The biggest reshuffles I have done over the last month was closing the hedges. I have already mentioned that, putting on directional long equity plays via SPXL and TQQQ, netting out the tilt duration, increasing exposure to gold yet a little bit, keeping the cash buffer a bit lower than in February, because we have bought into some of the sold out names. The February copiers count was 332%. So thanks again for that. It's really motivating to me. I hope you guys will stay here within the portfolio for as long as you can. I always repeat it. Please do remember that this is a long-term strategy, and investing as a whole is a long-term process. So basically stay away from doing very short-term moves, buying in and selling out. In the long run, the aim is to profit from the overall investment strategy and take advantage on the longer-term trends that are basically coinciding with how the economy performs throughout the economic cycle phase, and so does morph our portfolio as well. The major market drivers in March that I have personally seen and kind of written down for you were these. The EU equities were hit the most, obviously, due to the simple fact that the Russian invasion on Ukraine happened in Europe, and especially markets like Poland, for instance, where I come from, got hit a lot, but Western European developed markets got hit quite substantially as well. The German DAX index, for instance, was almost 23% down, top to bottom. So kind of a big plunge in a very short period of time. So at the mid of March, the markets were extremely oversold. Equity markets made the corrections low in the first half of the month, along with the de-escalation. So once we started getting information about both of the parties of the conflict trying to get involved into peace talks, obviously markets have started discounting that this conflict is basically going to morph into some kind of a longer term situation that is not so abrupt as it was over the first 2 weeks of the invasion. Equities were extremely oversold. I've mentioned that already. The latest FOMC meeting brought much more clarity as to rate trajectory. we have one rate hike in place already, and we're expecting another at least 5 to 6 rate hikes this year. So the FOMC has put out a pretty clear path of the Fed fund rate trajectory this year, obviously leaving themselves with an option to change it should the market conditions change. But all in all, the fact that we know more about what the Fed is going to do this year at least has obviously helped equities a lot in terms of giving the investors much more clarity and just an option to kind of prepare for the higher rates that are going to come anyway sometime later this year. Inflation finally stopped surprising to the upside. It's not still high. It's pretty much at its 40-year tops, but at least the last readings that we saw were not just full of positive inflation surprises versus the market consensus. So I think personally that in the very shortest term, possibly April to May are going to be the months where we should possibly see some kind of a top in inflation pressures. I'll come back to inflation in just a little second. Recession fears arise as certain parts of the yield curve invert briefly. There's been quite a few articles on that in the media already, namely the 2-year, 10-year, the 10-year, 2-year actually yield curve has not inverted. I mean, on an intraday basis it has, but it has basically flattened out to zero, and some of the analysts basically tell the view that this is an imminent view of a recession coming around the corner. I would argue with that. I think that the 2-year is basically 2 years out, right? So this is some kind of a message to the market that within the next 12 to 24 or 18 months, we should be preparing for tougher conditions. We should be expecting more unsustainability in the economy, and we should be preparing both ourselves and our portfolios for that. At least we do have the trajectory for the rates now, so we have a little bit more of clarity here, and this is important. But the yield curve definitely needs to be watched from here. Quick overview of the Fed. I have been showing this graph here on the right side since the start of this year, but I think it's very important. It basically shows that the FOMC is planning to decrease their balance sheet, and they are talking about this quite seriously. So it's not only going to be the interest rates hikes, but also a balance sheet runoff, which usually means much tougher conditions in the financial markets, which usually induces higher volatility. So even though we already had a massive burst of volatility around the conflict, the war conflict, I think there's more of that coming basically later this year once the Fed starts running down their balance sheet. The current level of Fed assets is still more or less $8.9 trillion. So it's not falling just yet, but it is flat for third or fourth consecutive month right now, pretty much. So I think sooner or later we will see it starting to fall. The oil shock that came around the Russian invasion on Ukraine, obviously we saw Brent at $130 plus, right, for short term. Then it corrected massively, but I think big increased volatility is going to stay in the commodity space, especially in terms of oil prices. The situation with Russia is still very dynamic. Western Europe and some other important countries in the world are basically shifting away from Russian oil. So this issue will definitely be a thing that will be impacting both price pressures, supply stuff, and I think it's possibly one of the biggest risks to a potentially big trouble, which would be a recession sometime later, as I said, within the next maybe 18, 24 months, depending on how the markets keep behaving and what other situations we face. The flat 10-year, 2-year curve, I have mentioned that already. The first rate hike is behind us, talked about this as well. We get another 6 hikes later this year, and the balance sheet run off, obviously, right? So all in all, we need to be preparing for tighter conditions and more volatility. This is my view. A quick look at the US inflation tendencies. As you see here, 14 out of 18 major inflation dogs are higher last month than the month before. In February, the ratio was 11 to 18. So as you see here, on an aggregate basis, the price pressures have yet risen versus the previous month, and pretty much every single indicator is now higher than the previous one. So we are there at the highs of a 40-year period in terms of inflation. I think in the shortest run we are at around the top, but we will have to wait and see for that, given the situation is so unpredictable right now. The worldwide macro heat map, as we usually run it, just quick again, inflation plus the government budgets that need to be monetized are still the two biggest troubles that I personally see. So I'll be watching that definitely. Inflation at 40-year highs, that monetization must continue. The first black swan of the boom phase that started in January is already behind us, the Russian invasion on Ukraine, and generally weakening consumer sentiment. It's one of the macro trends that I have noticed lately, and it's something that is pretty worrying, because you possibly know consumers basically the main power in the developed markets, economies that are based on services and production in general. So consumer is very, very important here. And last reading was 59.4 from 62.8 in terms of United States. As you see, the tendency is to the downside. So a worrying sign needs to be watched. Supply chains are still broken, and for now, in some areas of it, there's no light at the end of the tunnel, let's say, in terms of how soon and if at all they are getting fixed. So this issue has been with us for quite some time right now, since ever the COVID pandemic has broken out, and it's possibly going to stay here for yet quite some time. Price pressures are exogenous, so they are coming from the supply side of the economy. Mainly they have to do with commodities and a lack of commodities or troubles in supplying commodities. So unfortunately, this is this kind of inflation that we don't really want, because this is out of the control of the central banks, right? The Fed cannot control the prices and the supply shocks of copper, uranium, or coal or stuff like this, right? These are exogenous things that the central bank has no control over. So in this term, it's tougher for the central bank to control inflation, this kind of inflation that is coming from the supply side of the economy. As you see here, commodities is basically a massive trouble right now. In February 2022, you see, for instance, Brent was up 57% year on year, and in March it's up almost 70% year on year, right? Natural gas was up 60% year on year. Now it's up 122% year on year. Coal was up. Coal actually eased a little bit because it was at the top of the situation with coal was going hotter a bit faster than that. But pretty much most of the other indicators are either just as high as they were in February right now in terms of year-on-year dynamics, or higher, right? So this is something that is not ideal. Valuations have come off, obviously, over the correction period. So in terms of US large caps, for instance, we have corrected to below 20 times forward PE for other S&P indices. So the mid cap and small cap ones, the valuations are even lower. For the Russell 2000, we're at slightly below 23 times. So it's cheaper. It's still not necessarily super cheap, but there are more and more opportunities in general in some of the areas of the market where you can buy really sold off stocks with pretty wide economic moats that have a very solid balance sheet and good growth ahead for very often half the price of what it was yet a couple of months ago. So there's stock to pick from, basically. The PEG ratio, the one I very often mention, was even below 1 at the break of 2021 into 2022. Right now, we are somewhere at around 1.2, but this tendency, this trend will most possibly continue to go higher from here in the shortest term, given the fact that I think the bottom is in. The growth for now is still there, so most possibly, I would ideally want to be buying in at 1 or below in terms of this ratio, but I think we are not going to see it come very soon again to that kind of level where we were before, right? Obviously, in terms of PEG ratio, the lower it is, the better, right? So because it's basically higher growth for a certain company average or for an aggregate index of companies versus the PE. So high PEG ratio means very high PEs and lower growth, and low PEG ratio means high growth at low PEs. So this is the kind of ideal situation where you want to buy stock because you get cheap valuations, low PEs, and high growth, which is very good for someone that plans to hold the stock for a longer period of time. Trading PEs versus forward PEs. The forward ones are, as we said, below 20 right now in terms of S&P 500, and the trading PEs are at around 22 times. So also not extremely high in terms of trading PEs, as you see at the break of 2021, we were at close to 30, right? So the trading PEs have been on a downtrend, and it's okay, right? The market generally is getting cheaper, not only on the forward-looking basis, but also looking behind into history. Forecasts and expectations. We are still in the boom phase, according to our macro model. The Russian-Ukraine situation is the first black swan that we saw. As you know, boom phase is basically very vulnerable for black swans. I think that more of that coming later this year or maybe next year. Yield curve shape flattens, and in some duration setups, and I think it's really something to watch. And the coincident indicators are they are okay for now, but they need to be watched very, very closely, because we know we are in a phase where the coincident indicators are basically telling us whether we're getting closer to a potential cycle peak or not, right? The yield curve already kind of puts us on alert in this term, but the coincident indicators are all green for now. Everything, the delta, the private payrolls, and the industrial production in terms of year-on-year growth are nicely in the green. So no signs of war here just yet. Conclusions, we're expecting more increased volatility periods. As I said, the coincident indicators are clue to be watched right now. We have a flat 10-year, 2-year piece of curve right now, and we need to be watching how it is here and how it kind of buys into the 10-year to 3-month yield curve over the next 12 to 18 months. Stocks are cheaper right now, as we already have mentioned, but obviously the big question is the earnings growth rate and whether this is going to be enough to cover for inflation and tighter conditions. Objectives implementation so far this year, no hedges in March. That allowed us to profit from the rebound. We added some solid growth stocks, for, as you possibly see, PayPal is now our biggest holding right now that we kind of bought into at pretty good prices. We kept diversifying into value and cyclicals and into Europe to some extent as well. I'm planning to stay opportunistic this year. I have put it very clearly at the break of January that this year is going to be about volatility, and I do plan to use it into our favor. I will not get married with any positions if the situation changes as it does. Protecting the portfolio's capital is the very first point on my list, right? We're staying flexible with positioning. We're trying not to exceed 60% of overall equity exposure. That's also in line with the cycle phase right now, which is the boom phase. And I plan to keep higher general exposure to commodities for the reasons I have already mentioned, which is the commodity inflation. My view, recession is still not the base case scenario over the next 12 months for the reasons I have already laid out shortly. More volatility. I do plan to continue hedging depending on market conditions, and I do think that the yield curve behavior is pretty typical for this late cycle phase we're in. So even though some of the parts of the curve have flattened already, I don't think this is an immediate threat of recession. At the end of this year, we're planning to see the Fed funds at around 1.92 or higher. So we'll to watch how the long side of the curve reacts to it and whether it also goes higher or maybe not that much as the Fed funds do. This will tell us a whole bunch of stuff about the state of the economy and whether it's strong enough to cope with a higher Fed fund rate and increased inflation, or maybe it starts to be fading into some kind of recessionary period. Guys, this is it for this month. Sorry to be keeping you on hold for so long. Please do always remember that the longer you copy the portfolio, the better it is for you, the more you profit on compounding and time, which are the two major things in finance that add value in general. Please do remember that the suggested minimum copy amount is $500, and please always do copy open trades. If you copy for less than 500, obviously it should still be fine, but the replication of the portfolio might just be a little bit less accurate. And please always be patient and resilient to turbulence. I always repeat that, but it's very, very important. Thank you very much. I'll hear you next month with the usual update. Thank you.